Are you a first-time home buyer that is eager to start that life-changing step towards home ownership and start building towards your net worth? If you are, and you're wondering about this pivotal moment that's going to kick off this incredible journey, we've got the answers that you're looking for. In this game-changing video, we are discussing one of the crucial items. What is the minimum credit score needed to start the process of purchasing your own home? Now, don't let this opportunity slip away. Get equipped with the knowledge and confidence to turn that dream into a reality. Now, stay tuned as we progress through these next steps. Many people ask this question as they start the process, and it's an important one to answer. You know, there are three main criteria that an investor is going to look at for a credit approval when making a consideration for a mortgage loan, and that's credit, income, and assets. So knowing where your credit standing is and what the requirements are really important. Now, when you're buying your first home, predominantly most people are going to be buying that as a primary residency. That's what the intent of that property is going to be for. If you're watching this video and you're going to be purchasing a home as a second home or an investment property, we have some other videos that would be a lot more impactful in that scenario. So right now, as we continue on, we're just going to assume that anyone who's still watching this is going to be buying as a primary residency. Now, there are really two main programs that are really popular, conventional and FHA. Both have some great options, so why don't we go ahead and break these down first. Now, conventional loans are really some of the most traditional loans that we have out there in the marketplace. If you've ever heard of the names of Fannie Mae or Freddie Mac, these are traditional conventional note holders. That means they're going to hold these notes for the long term, but it also means that they're the ones who come up with the guidelines or the criteria for lending on these loans. So they are very specific on their number. They want a 620 credit score or FICO score for the borrowers who are going to come in on these loan applications. So if you have multiple people, maybe a husband and wife or two people buying a home together, everybody must meet that minimum credit score. You can't have one with a really high score and one with a really low score to try to balance that out. That minimum credit score applies to anyone who is on the application. So FHA loans are also another great option to consider. Now, what makes FHA a little bit different is that they allow a little bit more risk to be considered. Now, FHA loans are considered government subsidized or government insured loans. So there's some additional insurance that is placed on this through the government. They have a monthly mortgage insurance premium, but they also have another premium that's layered into the loan, and that offsets the risk for the investor, so they're willing to be a little bit more flexible. So they will actually allow those credit scores to go down to about a 580 for each applicant, plus they'll allow for some more flexible criteria when it comes down to the debt level that maybe a borrower or a pair of borrowers have. It's called the debt to income ratio. They'll be a little bit more flexible in those options. Now, with the first time home buyer incentives they have and with the additional insurances that they have, you might be able to get a better payment on FHA to start off with. So making sure that you look at conventional and FHA options both is just a smart thing to do. Now, another option that can be considered are VA loans. Now, VA loans are very similar to FHA loans. There is some additional government insurance that kind of comes into play. They will also allow down to a 580 credit score and have a lot more flexible options than a conventional loan when it comes down to some of the debt structures that are allowed. The caveat with that is that you have to be a veteran and you have to meet some qualifying criteria to be approved for a VA loan. We have some other videos that are in our arsenal that you can jump into if you feel that you may qualify for one of those. Now, another question that we get quite often is, what can I do to help improve my credit? So we want to go through just a little bit of a breakdown here for you on where these things are impacted on your credit scores and what you might be able to do with each one. A great place to start is to begin with the breakdown of what is included in a credit score. There are actually 5 different categories and different percentage of each category that build in to what accumulates for your credit score. The first section is payment history. Now, this makes up about 35% of your credit score, and you want to maintain a solid payment history. Now, credit card companies or investors cannot report you late until you go more than 30 days late. So when it comes down to payment history, you're looking at 30-day lates or 60-day lates or 90-day lates per a credit report and how they're scored. We really recommend you don't go more than about 15 to 20 days past due to make sure that payment gets in before that cutoff. Now, the investor may have a penalty themselves for not making a payment on the due date, but they cannot report to the credit bureaus until you're more than 30 days late. The next section is amounts owed. This takes care of about 30% of your credit score. And this is an area that we really kind of look in and analyze and help people understand maybe faster ways to improve their scores. You really want to keep things like credit card balances to about a 25 to 30% of the limit. So for example, if you had a $1,000 limit, you don't want your balance to be more than $250 to $300 once it reports to the credit bureau. If you go up on that, you can always pay it down to those levels to make sure it's there before they report. Creditors only report to credit bureaus once every 30 days typically. The next section is length of credit history. This carries about 15% of your score. It's important to build time on your trade lines. We have some clients that say, well, I just don't like to use credit, so I don't. That's fine, but you're not going to really help build a credit profile by not using it. If you don't have any credit, and if you have a family member or someone who you're very close with that may allow you to be an authorized user on one of their accounts, that might be a way to kind of work the system to get some additional length of credit history. Credit mix is the next section. This carries about 10% of your credit scores. We have revolving types of accounts, and that's like credit cards. You charge on it, you pay it down, you charge on it, you pay it down. It's revolving and kind of continues to move. The next one is an installment account. This is traditionally like an auto loan. Let's say I borrow $40,000, I have an $800 payment, and I make it for 50, 60 months, and then that account or that loan is done. That would be an installment debt. And then what we're applying for here is a mortgage account, and that is also part of that credit mix. New credit is the last section. This is about 10% of your credit score. We see this more for people that are trying to build credit. They can't really get into a credit card because they don't have any established credit. The way to get some new credit here is look into secure credit cards. This will help you start some new credit. And what it does is you put down a deposit, and that acts as your limit, and then you treat it like a regular credit card. So typically, I think the minimum is around $300. You put that in there. That is your credit limit. Don't use more than about $100. Maybe go charge a couple tanks of gas, make a minimum payment, and start building that history, which goes into the mix, and then the amounts owed, and that helps to start generate that credit score. The last item that you really want to pay attention to, if you have not looked at your credit report, are collections. Are there any collections that are on there? You want to address these. Not leaving these alone is not always the best idea, and paying them off immediately may not be the best idea either. You want to talk to somebody who has some experience here. You might be able to negotiate some better terms. It may be better to pay these over time, but you do want to address them and figure out how to alleviate them. Some people believe that if you leave them alone for 7 years, they just automatically fall off. That's not 100% true. Typically, it's 7 years from the date of last activity. So our main philosophy is to leave people better than we've found them. And just kind of going through the credit scenarios with clients is a really impactful way to do that. With over 25 years of experience in this industry, I've seen thousands and thousands of credit reports. So our eyes know really where to go and maybe look at some impactful pieces that can bring some improvements to maybe what your situation is. We had a wonderful client that we would work with years ago come back to us earlier this year. Unfortunately, they had gone through a separation and a divorce and then had taken some impact points to their credit. After a short review, we made some suggestions on areas to concentrate on. Long story short, about 90 days later, we went from a below 580 credit score to well over a 640 to almost 660, which opened up loan options for her. We didn't just have one, we had a few, and it's just based on that reference of information that we have. We want to leave people better than we found them. If you're on the path to home ownership, getting the right information is going to be crucial to making sure you know what your next step is. If you don't take those steps and you don't have the information, most likely you won't do anything at all.